Welcome back, everyone. Thank you all for joining. I'm so excited today because we're going to be going over a stock that I actually locked in over 300% in profits on. I'm really excited about this one, and I feel like I timed this probably correctly. And it's a stock that I love. I love the company. I love the management team, but the TLDR of this whole entire video is the reason that I sold it because I believe it's overvalued based on the underlying fundamentals, based on the industry that they're in. And the stock we're going to be looking at today, or the company rather, it's going to be Revolve Group, or Revolve RVLV. And I'm really excited to take a look into this today. I wrote a Substack article if you'd rather read it, but I figured let's do a little video format. If that's what you're into, make sure to hit the like and subscribe content. We're going to keep track of a bunch of different companies here on the channel, and I hope you guys stay tuned. Let's hop right into it. Now, first things first, if you ask yourself, what is Revolve? You know, what do they even do? I've never heard of Revolve. Why am I just hearing about this three-bagger opportunity now? Well, Revolve Group is actually a high-end luxury fashion brand, pretty much. It's really more of a platform, but it's a brand that they built their whole entire platform off of using Instagram, influencers, YouTube, and really what they did is they advertised through these influencers to really build out that brand and actually create a following, and now they have a shop that does extremely well. Obviously, with that luxury brand, they're able to sell things at a higher price. And I think that overall, they're at a very good starting point as to where I see them going into the future. But again, I believe they're overvalued, and we're going to walk through why in today's video. Now, the way that they break out the brands, you have Revolve and you have Forward. Forward is kind of that premier piece of it versus Revolve is more of it kind of encompasses everyone. Both are probably more so on the pricier side than what you're used to seeing, and I know that they're kind of trying to expand into that. But one of the best parts about their business model is that because it's not like a retail store like you would think of, like a Nordstrom or maybe H&M, Forever 21, those kinds of stores, you actually have the opportunity of not carrying as much inventory and having a way better inventory management control. And that's kind of what they do, and that's why they've been so successful, especially through the entire pandemic. They're not sitting on a bunch of inventory. They're making moves very quickly. They're making moves with the different suppliers that they have and actually bringing products to market that people want. So when they moved into sort of the COVID era, when we first started back in March of 2020, the management team actually cut their salaries and made sure that every possible dollar was going back into the business, back into their employees. And I think that's very important to notice from a management team why they're so key to all this. They really care about the business. They want the business to be successful, and they clearly have throughout this whole entire pandemic, because they actually ended, I believe it was Q3 2021 or Q2 2021, no debt on the balance sheet at all, which is pretty insane if you think about what we've been going through over the last year and a half. And the fact that they have no debt on that balance sheet is absolutely amazing. Clearly see that they have some sort of management team that cares about the financials of this. And I think that's part of what made me buy into it originally. Now, as far as sort of what they're into, how they attack the market, their focus is on the female demographic and mostly, you know, Gen Z, millennials, sort of the younger end of the spectrum. And the reason is, again, because they're using influencers to get into the markets that they want to get into and get into the target audience really that they want to get into. And I also think that one of the craziest things is that when the COVID situation all happened, the stock dropped to $7, right around $7, $8. And I could not, I was scared. I couldn't possibly tell myself to buy at $7, $8. I understood the business, I understood the management team, but I couldn't bring myself to buy it just because I was too scared of what could possibly happen to the business model. Obviously now, hindsight being what it is, I'm like, oh, I should have bought way down here. But if you look at the chart that I'm about to pop up on screen here, you can see that I bought in around the $15 to $18 mark. I think my ending cost basis ended up being around 18 bucks. So I ended up buying on the upswing, and I actually ended up buying in November, or at least I ended my purchases in November of 2020. So the bottom hit around March 2020, and I actually hit all the way through November. So I was definitely buying. It was something I was looking at, and it was really something that I didn't think it was going to do so well. I didn't know how well it was going to do, but the price that it's at now is what I predicted years from now, not in 1 year. So you can see though, I bought around the $15, $18 mark, and I ended up selling at about $85, I think is what my selling price was at the very end. And I sold just a little over a couple weeks ago. At the time of this article is about when I sold it. So right around the $85, $89 mark was right when I sold it. And you can see that it's kind of fallen off. And that's just because of all the COVID fears that we have with the new variant. And I think that the supplier shocks and all that stuff might be wearing off, but I wasn't comfortable with the current valuation that it's at. And then seeing all the other companies go down at the same time, I was like, let me just pull some profits off the table. And you guys are going to see why here in a moment. I think it's a little overvalued. So let's hop right into it. Now, first things first, you're going to see that they break out their segments in terms of their revenue in between the Revolve and Forward brand, and they also have the United States and the international. So they separate out, and they're building out their international a lot. They're really trying to get into the international game, but they break it out into the two different, and I feel like if you're looking at this business, the market that you're trying to get into, they're going to grow that international brand a lot quicker, but you want to make sure that the United States is staying steady and steadily going up, because overall, the business is going to be driven, initially at least, by the United States brand and market and consumer. So you want to pay attention as far as this brand goes. It's a luxury brand. So if people start losing money, credit starts going down, this is probably going to be one of the first companies to kind of drop down, at least on the stock pricing, because people are going to get scared that the company is going to do bad. It may or may not, but I think in terms of stock price risk is really what my concern was for this one. You can see though, overall throughout 2021, over the last 9 months, they've almost doubled, a little under doubled in terms of their revenue for the net sales. And then obviously for the gross profit, they've gotten about 50% up from where they were in 2020 last year. And that's not surprising at all, because they took a big hit in terms of 2020's numbers in general. They took a huge hit because a big seller of this company is the sort of dresses, and think of like the festival wear and the festival sort of outfits and things that people wear to things like Coachella, EDC, I don't even know, Rolling Loud. There's a lot of other concerts that people go to. I can't even think of off the top of my head. But just think of all of these brands that people want to get into, and people want to show up with something unique. They don't want to come in something that someone else has. I think that's what Revolve and Forward both offered for people, is just the idea of you can make this how you want to look. You can be exactly how you want to be. You can look how you want to look. You can dress up however you want to be. But in terms of just the offerings, I feel like Revolve has a better chance of you not having the same thing as someone else, and maybe having a little bit more of a unique work. But definitely that festival attire and the dresses was a big component of their revenue and their sales just in general. So as you see the sales kick up this year, it's really due to the fact that festivals have come back for most countries. I don't know if some countries have festivals back. Definitely United States, we have them back. And then also you have just dresses to go out, go to places, go to bars, clubs, all sorts of different outings. Maybe you just want to wear it to a nice cocktail party. These are the kinds of dresses that get offered, and it's a really high-end feel, even if it's not a crazy high-end price. I think that's really where the market is for Revolve though. And then obviously tacking onto this, you can see that on here we have a net revenue. I believe this is a TTM. Yep. So you have a net sales of around $793 million. This is over the last trailing 12 months, so TTM, and they've been growing huge. And I think a big component of this is the festivals opening back up, dresses just being more in style because people aren't working from home as much. And then obviously you can't leave this one out. People got stimulus checks, whether it's the stimulus checks, the family tax credits, whatever kind of money that we got back this year, people got back in a big way, and a lot of people spend it on luxury goods that they didn't need the money. So they're going to probably buy Revolve. They're going to probably buy Forward. It's really noticeable, and the management even mentioned that the stimulus checks really helped their net revenue this year. And so it's something that really, I mean, when you're comparing numbers year over year, I would compare 2019's numbers to 2021's numbers rather than comparing 2020. It's 2020 is going to look really good because it's just an off year. So I would compare, if you're going to look at this business and look at the 10K, make sure you compare 2019 and 2021. They do this on their own investor presentation, and I think that that's a good thing to recognize from the management side. They're still doing really well in terms of growth, but if you're going to compare numbers, make sure you compare, I guess, normal years is what we'll call it. Other than that, you have the financials. Like I said, the total revenue TTM was about $792 million. The profit margins floating anywhere between 10 to 12%. Obviously, you have that gross margin is about 50-55%. And I think that the margin on this business is only going to go higher as they're able to kind of get into the dresses more, sell more dresses, and sell more of the high margin products. And also getting into the international sales will help them as well. Again, they're not handling a ton of inventory. So for them to flip on a dime, make sure to move inventory and make sure to sell different products different times of the year, they can do that very easily. Now, the current PE is 70. And that was at the time of writing this article, but the current PE is 70. I think that's come down a little bit, but even at 60, you can see where my hesitation really came from. And then obviously, enterprise value to EBITDA is about 64 at the time of writing this article. Current cash on the balance sheet, this is a really good thing. The current cash on the balance sheet was $221 million, and then they had zero debt, like I mentioned, as of Q3 2021. So, I mean, for a business like this, it's really up to you in terms of the risk that you're willing to take at this valuation. When I bought in, I think it was around 20 price to earnings. Even then, I was still a little hesitant because I felt like that was a little high, but clearly we can make 350% on this, and it can still keep going higher. But I mean, that's been the market this whole entire year. So I'm not surprised after seeing how everyone else has done this year, but this definitely was one of the companies that I wasn't intending on selling so soon, but I can't justify the valuation currently. Now, as far as the industry goes, I looked at a couple different reports, but for the most part, it seems like from researchandmarkets.com, the luxury and fashion market size was valued at around $110 billion in 2020. It's expected to grow to $153 billion by 2026. So that's growing at about a CAGR of 5.66%. And I really look at the industry when you're getting into this one, look at the fashion, look at where it's going and see how fast it's moving. They do a great job of handling the millennial and Gen Z generation in terms of their fashion and marketing. But that's definitely the primary driver. So if that starts to pull back or that starts to dwindle down, that's something to pay attention to. So I would definitely look at the fashion industry as a whole, see where it's going, and decide if this is something you want to get into. Now, one of the benefits for their customer demographic is the fact that they have zero debt and that they're using that social media. And I feel like social media is only going to get bigger from here. So if you believe the story of their influence through social media, using influencers, then I think this is a company you can get behind. But again, you're going to see the valuation here in a moment, why I think it's ridiculous. Outside of the price to earnings ratio and the price to free cash flow ratio and the enterprise value to EBITDA ratio, you're going to see here why this run-up really, I don't think, was justified. So we're going to hop on over to my discounted cash flow model. So first things first, outstanding shares, you got 72 million shares outstanding. You also have a current revenue of 792 million, like I mentioned. Again, the current stock price at the time of me filming, at the time of me actually taking the screenshot, was about $79. The market cap around $6 billion. And then obviously zero debt. The current free cash flow is about $63 million. And then you had net income of $889 million. So the price to earnings on that was about 64. The price to free cash flow on that was about 90. So that's something, if you're gonna seriously buy into this, you need to believe in the story and that they're gonna grow like absolutely crazy. Because I did some just like, I would even say it's a little above conservative numbers, and even I question holding this. And that's kind of why I sold off and why I made the move that I did. So as far as the net income, I'm going to call this the everything money indicator. So we use the share price, we use a share change of 5%, 3%, 1%. The revenue growth was 15%, 20%, 25%. That's a lot. That's a lot. I don't care what this company's at. That's a high growth. That's what I'm saying. This wasn't a conservative approach. This was very much a very high growth. So profit margin, we're going to do 11, 13, 15%. Free cash flow will do 10, 12, 14%. And then PE and price of free cash flow, you did 18, 20, 25. Now I did a discount rate of 12.5%. Again, this is all straight off of Everything Money. I love their channel. I feel like this is probably one of the best ways to do discounted free cash flow. But you can see on the way that they do it, basically they break it out into 3 different cases. So you have worst case, best case, base case, or base case, best case. The net income is just taking the discounted cash flow based off the net income and taking the discounted cash flow off of the free cash flow. Now, the idea is that you want to pay below the base case. You want to pay in between. Remember, these are indicators. These aren't like hard numbers. But the idea is that what is the business worth based on all of these assumptions? And is this a reasonable assumption? That's kind of what it all comes down to. But the base case for net income is $40. The base case for free cash flow is $37 per share. We're at about 70, give or take, today. So that's where my problem became. So, and then at the very bottom, I just did my own free cash flow evaluation. I have the cost of equity around $46. So for me, that's 46 is about where I would have liked to pay. And clearly, if we're at double that, that's a problem. And so what I did is I just held it until I hit that long-term mark, so that year mark, and I just sold off my shares so that way I could take some profit off the table. And I actually lucked out and sold right before. We've kind of had this whole December sell-off of people taking tax loss harvesting, really just moving money around, deleveraging. All this money is flowing all over the place. But I just wanted to take some profits off the table, lock that in. And I think that for me personally, I put in 300, I got out 1,000, I think, give or take 1,000. I'll put it up on the screen here, but I got give or take 1,000. So I'm happy with that. I'm happy with my profit. I'm just going to take my profit and run, put it into some new stocks that you guys can see on the channel here. But let me know if you have any comments down below if you want to take any look into any more stocks, or I'm going to be trying to see if I can get through a bunch of stocks here that I've been interested in and kind of explain my thoughts, whether I think they're overvalued, undervalued, if I see any opportunities there. But stay tuned to the channel. If you really like what I do, make sure to hit that subscribe button down below. Make sure to leave a like on the video. Hope you all have a great day. This is Josh Castillo signing off.